Something is shifting beneath the surface of the silver market, and almost no one is watching closely enough to see it. For months, silver has moved sideways, trapped, contained, quiet. But quiet markets do not stay quiet forever. Somewhere between a central bank vault in Beijing, a mining shortage no one is talking about, and a decision being made in Washington this year, the next move in silver is already being written. The only question left is this: will you see it coming before it happens, or after? Stay until the end, because Part 5 reveals the single trigger that could change everything. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand markets before they move, not after. This is not a channel for noise or speculation. This is a channel for pattern, precedent, and preparation. If this analysis earns your attention over the next few minutes, consider becoming part of this community by subscribing. Not out of obligation, but because serious economic thinking deserves a serious audience, and that audience is exactly who we are building here, one thoughtful viewer at a time. And before we begin, we would genuinely like to know, where in the world are you watching this from today? Drop your city or country in the comments below. This channel reaches thoughtful viewers across every continent, and it is always worth knowing who is on the other side of the screen. Now, let us begin. On the surface, the silver market looks calm. For months now, the price has moved within a narrow range, rising a little, falling a little, but never breaking free in either direction. To a casual observer, this might look like boredom. It might look like a market with nothing left to say. But those who study economic history know something important. Quiet markets are rarely as quiet as they appear. Throughout history, long periods of price stagnation have often come before some of the biggest moves markets have ever seen. This is not a coincidence. It is a pattern that has repeated again and again in different decades, under different conditions, with different players involved. When a market trades sideways for an extended period, it usually means that buyers and sellers are locked in a kind of standoff. Neither side has enough strength to push the price decisively in one direction. But standoffs do not last forever. Eventually, something shifts the balance. And when it does, the move tends to be sharp, fast, and difficult to predict in its exact timing. Silver has seen this kind of pattern before. In the late 1970s, silver spent years trading in a relatively narrow band before a dramatic surge caught much of the world by surprise. Investors who were not paying attention missed the early signs entirely. They only noticed once the price had already moved significantly, and by then, it was too late to enter at a reasonable level. A similar pattern played out again between 2008 and 2011, when silver spent time consolidating before eventually climbing to levels many analysts had considered unlikely just months earlier. The lesson from these moments is not that silver always goes up. Markets do not work that way, and anyone who claims otherwise is not being honest. The real lesson is that periods of calm often hide pressure building underneath the surface. Prices reflect what is known and expected today. They do not always reflect what is quietly changing in the background, out of view for most traders and everyday investors. This raises an important question, one that sits at the center of this entire analysis. Is the current price of silver actually telling the full story? Or is the market simply behind the curve, slow to recognize shifts that are already taking place in supply, demand, and global economic behavior? Prices are not always efficient in real time. They often catch up to reality only after enough evidence becomes impossible to ignore. By then, early movers have already positioned themselves, and everyone else is left reacting instead of preparing. This is precisely why understanding the forces beneath the surface matters so much right now. A calm chart does not mean nothing is happening. It often means the opposite. It means the market has not yet decided how to price in new information, new pressures, or new realities that are forming quietly, piece by piece, month by month. For business professionals and serious investors, this distinction matters. Reacting after a move has already happened means paying a higher price for the same asset, and accepting more risk for less potential reward. Understanding the pressure before it becomes visible to everyone else is a very different position to be in. It requires patience, discipline, and a willingness to look past short-term price action toward the deeper forces shaping the future. So what exactly is building beneath this quiet surface? Some of it has to do with how silver is actually used in the modern economy, far beyond jewelry or coins. Some of it has to do with decisions being made by powerful institutions, far from the daily headlines most people read. And some of it has to do with monetary policy decisions that have not yet fully played out. Each of these forces, on its own, might not be enough to move the price dramatically, but when multiple pressures build at the same time in the same direction, history has shown that the results can be significant. The current stability in silver may not be a sign of weakness or irrelevance. It may simply be the calm before markets begin to price in what has already been quietly taking shape. The first of these forces begins not in a boardroom or a central bank, but in factories, power grids, and technology supply chains around the world, where where silver is being consumed at a pace few people fully appreciate. Most people think of silver as something you hold, not something you use. A coin in a drawer, a bar in a safe. But this view misses a huge part of the story. Silver is not only a monetary metal, it is also one of the most useful industrial metals on Earth, and that fact is quietly reshaping the entire supply picture. Silver conducts electricity better than any other metal known to science. It also conducts heat extremely well and resists corrosion in ways few materials can match. These properties make it essential, not optional, in many of the technologies driving the modern economy forward. Solar panels need silver. Electric vehicles need silver. Smartphones, medical devices, and advanced electronics all rely on small but critical amounts of silver to function properly. And unlike gold, which is mostly stored and rarely destroyed, a large portion of industrial silver is used up. It gets embedded in devices, soldered into circuits, or consumed in manufacturing processes that make it difficult and often uneconomical to recover. This is where the story becomes serious. As the world continues investing in solar energy and electric transportation, the amount of silver required each year keeps climbing. Solar panel production alone has become one of the largest single sources of industrial silver demand in the world, and that demand has grown consistently for years, not months. Every new solar farm, every new wave of electric vehicles, and every new generation of electronics adds more pressure to a supply chain that was not built to expand indefinitely. Meanwhile, mining production has not kept pace. Finding and developing new silver mines takes years, sometimes decades, and it requires enormous capital investment with no guarantee of success. Most silver, in fact, is not even mined on its own. It is typically produced as a byproduct of mining other metals like copper, lead, and zinc. This means silver output is largely controlled by decisions made in industries that are not even focused on silver itself. If copper or zinc production slows down for unrelated reasons, silver supply slows down with it, regardless of how much the world actually needs. The result of these two forces moving in opposite directions is what analysts call a structural deficit. In simple terms, this means more silver is being used each year than is being newly produced. This gap has to be filled somehow, usually by drawing down existing above-ground stockpiles that were built up over decades. But stockpiles are not unlimited. They can absorb temporary imbalances for a while, but they cannot absorb them forever. Every year the deficit continues, the cushion becomes thinner, and the market moves closer, to a point where scarcity becomes difficult to ignore. What makes this especially important is that most short-term traders are not paying attention to any of this. Daily price charts are driven by speculation, short-term sentiment, and headline news. They rarely reflect slow-moving structural trends that build quietly over several years. A trader watching silver day-to-day sees noise. An analyst studying supply and demand over a 5 or 10-year period sees something very different. A pattern of consumption steadily outpacing production quarter after quarter with no clear solution on the horizon. This is not a temporary imbalance caused by a single event. It is the product of a long-term global shift toward electrification and renewable energy, combined with the physical and economic limits of mining new supply. These are not forces that can be reversed quickly, even if silver prices were to rise sharply tomorrow. New mines take years to bring online. Industrial demand, once built into global infrastructure, does not simply disappear. For business professionals and long-term investors, this industrial reality changes the entire framework for understanding silver. It is no longer accurate to think of silver purely as a speculative asset or a hedge against uncertainty. It is increasingly a critical industrial input, competing for limited supply in a world that is becoming more electrified every single year. That combination, monetary asset and industrial necessity, is rare, and history suggests it does not stay quietly priced forever. But industrial demand is only one piece of the puzzle. While factories and engineers quietly draw down the world's silver supply, an entirely different group of buyers has been making moves of their own, far from public attention and far more strategic in nature. While engineers and factory managers quietly consume silver for solar panels and electric vehicles, a very different kind of buyer has been active in the background. These buyers do not care about circuit boards or manufacturing lines. They care about something older and more strategic, monetary power. And the metal they have been accumulating in record amounts is gold. For several years now, central banks around the world have been purchasing gold at a pace not seen in decades. This is not a small trend or a minor footnote in financial reports. It is one of the most significant shifts in global reserve behavior in modern history. Countries such as China, India, and several others across Asia and the Middle East have steadily added to their gold reserves year after year, often in amounts that surprise even seasoned analysts who track these numbers closely. Why does this matter for silver? Because history shows a consistent pattern. When central banks and large institutions increase their gold holdings, it is rarely just about gold alone. It often reflects a broader strategic decision, one focused on reducing dependence on a single currency system and increasing exposure to hard physical assets that cannot be printed, inflated, or controlled by any single government. Gold usually moves first in this kind of shift. It is more liquid, more widely recognized, and easier for large institutions to acquire in massive quantities. Silver, being a smaller and less liquid market, tends to follow later, once broader interest in precious metals begins to spread beyond central banks and into the wider investment community. This lag is important to understand. It does not mean silver is being ignored forever. It means silver is often simply a step behind gold in terms of institutional attention. Once gold accumulation becomes widely recognized as a long-term trend rather than a temporary reaction, capital tends to spread outward, and investors begin looking for related opportunities that have not yet moved as dramatically. Silver, with its dual role as both a monetary and industrial metal, often becomes one of the natural places that attention turns to next. There is also a deeper theme running underneath these central bank purchases, one connected to global economic positioning rather than short-term price speculation. Discussions around reducing reliance on any single dominant currency for international trade and reserves have grown louder in recent years. Whether or not these discussions fully reshape the global financial system, the behavior of central banks suggests that many countries are preparing for a world where physical assets play a larger role in national reserves than they have in recent decades. This is not a prediction based on speculation. It is an observation based on documented, verifiable purchasing patterns that continue to be reported year after year. It is worth being clear here. This is not about conspiracy theories or dramatic predictions of currency collapse. It is about recognizing a pattern of behavior among some of the most powerful financial institutions in the world. These are organizations that plan on long time horizons, often decades, not days or weeks. When they act with this level of consistency and scale, it tends to reflect deep strategic thinking rather than short-term reaction to headlines. For business professionals watching global markets, this pattern offers an important lesson. Large institutions rarely announce their intentions directly. They do not send press releases explaining their long-term strategy. Instead, their intentions show up quietly in the data, in reserve reports, in purchasing patterns, and in gradual shifts that take years to fully reveal themselves. Those who pay attention to these slow-moving signals often have more time to prepare than those who wait for the trend to become obvious to everyone. Silver has not yet seen the same scale of institutional accumulation that gold has experienced. But the historical relationship between the two metals suggests that this gap does not usually last indefinitely. As global attention toward gold continues to grow, and as investors search for related opportunities within the broader precious metal space, silver remains a market that has not yet fully caught up to this larger, slower-moving story. Yet accumulation by global powers is only part of the picture. Behind these strategic moves sits another force, closer to home, shaped not by foreign central banks, but by decisions made inside a single institution in Washington. Every long-term story about precious metals eventually returns to one place: interest rates. And more specifically, it returns to the decisions made by the Federal Reserve. This single institution, more than almost any other in the world, shapes the environment in which silver either struggles or thrives. To understand why, it helps to think about what silver actually is from a financial point of view. Unlike a bond or a savings account, silver pays no interest. It generates no yield simply by being held. This means that when interest rates are high, investors face a real cost for holding silver instead of interest-bearing assets. Money sitting in silver is money not earning a return elsewhere. This opportunity cost makes silver less attractive during periods of high rates and more attractive when rates fall. This relationship is not theoretical. It has played out repeatedly throughout financial history. When the Federal Reserve raises interest rates aggressively, precious metals often struggle to gain momentum, even when other supportive factors are present. But when the Federal Reserve begins cutting rates, especially after a long period of restrictive policy, precious metals have historically responded with some of their strongest performances. Lower rates reduce the opportunity cost of holding non-yielding assets. At the same time, they often reflect a wider economic environment of slower growth or rising financial stress, conditions that naturally increase demand for reliable stores of value. This is why current monetary policy deserves such close attention. After a period of historically restrictive interest rates aimed at controlling inflation, the broader question facing markets is not whether rates eventually come down, but when and under what conditions. Persistent inflation, elevated government debt levels, and slowing economic growth all create pressure on policymakers, often pulling them in different directions at once. Fighting inflation calls for higher rates. Supporting growth and managing debt burdens often calls for lower rates. This tension places the Federal Reserve on an increasingly narrow and difficult path, one with fewer easy options than in previous decades. History suggests that this kind of tension rarely resolves quietly. At some point, economic pressure forces a decision, and that decision tends to have significant consequences for markets that are sensitive to the cost of money. Silver, given its non-yielding nature, sits directly in the path of these consequences. A shift toward a lower rate environment, especially one driven by economic necessity rather than simple preference, has historically served as a powerful tailwind for precious metals. What makes the current environment particularly worth watching is the scale of government debt now present in the global economy. Higher debt levels increase the pressure on policymakers to eventually favor lower interest rates, since high rates make the cost of servicing that debt increasingly difficult to manage over time. This creates a long-term incentive structure that leans, gradually but persistently, toward easier monetary policy, even if the path there is neither straight nor quick. For business professionals and long-term investors, the key takeaway is not about predicting the exact date of any single policy decision. Precise timing is notoriously difficult, even for professional economists. The more important insight is recognizing the direction of long-term pressure building within the system. Interest rate policy does not operate in isolation. It interacts directly with the industrial demand pressures already reshaping silver's supply picture, and with the strategic accumulation patterns already visible among central banks around the world.